Today, are you being enticed into the market? Hello, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian and New Zealand perspective. And today I'm joined again by property expert Joe Wilkes. Hello, Joe.
Hello, Martin. How are you?
Great. Good to see you again. And, sunny New Zealand once again.
It's a fantastic day. We're all recovering from the rugby result of the weekend, which unfortunately didn't go the right way. But I think it'll be hopefully a wake-up call for New Zealand to pull the socks up for the World Cup next year.
Yeah. Well, I think the All Blacks are in a better position compared with Australia's team. I think we didn't do very well, and we're not performing at all. So, what's new?
Exactly. Well, no, thanks for having me back again. We've it appears that we've created a little bit of a stir with our last three posts, and a couple of comments that have come back. I've had a few people looking at my LinkedIn profile over the last few days, which is quite interesting, because some of them seem to be from people who are representing the banking industry. So, not one to sit on my laurels and challenge the mainstream. I thought we'd start again and have another discussion. And this time, I'd like to talk about banks today, if you're happy with me doing so.
Sure. No, absolutely. Well, of course, the banking sector and the real estate sector and the mortgage sector are all sort of, locked in together. And I guess they all rise or they all fall based on what's happening in the property sector. Yeah,
very much. And having been involved in the industry in the UK during our credit issues after the GFC, and actually as a home buyer myself, there was a 4-year period where, as an estate agent, I was unable to get mortgage credit. So I think it's important to go and highlight some of the challenges, and also I think some of the risks, because there's been, in my opinion, there's been quite a change in focus over the last 12 to 18 months. It's been evident that yields in New Zealand don't stack up and haven't done in very many places. I mentioned to you the property in the block development that I saw a couple of weeks ago that come back to the market, having been bought in 2016. So it would have been one of the early purchases there. And on a purchase price in 2016, 1.25 million. The landlord had only been getting $750 a week renting, and you and I know that to repay a mortgage of 1.25 million, you'd need to have 13 to 1400 at current interest rates to actually service that debt over 25 years.
Just on that, it's worth making the point, right? Interest rates are really low at the moment, right? And prospectively may rise a little higher. But also, I guess there are also management charges and other maintenance costs, which you've also got to take into account if you're actually running an investment property. Yeah, and the investment properties for me, I hear so many investors who have been topping up rents with income of their own, and even though they've got negative gearing allowances, many of them they still don't stack up. So it hasn't seemed to me to be the most sensible investment. It's quite interesting, the press over here, and this is what I want to talk about, the press, their relationship with the banks and the promotion of property as the thing for everybody's future, and it's something that there is a generation of people who have really been sucked into this. And my concerns are now that the press have changed that focus from go and buy an investment property and get into the market, and you make a couple of 100,000 capital gains over 2 or 3 years. At the end of the cycle, that focus has been flipped with the bank adverts, and I've actually provided a couple of bank adverts that I'd like to sort of run through. The first one is an ANZ advert, which is a home loan coach.
We have a beautiful family home here, ladies and gentlemen. Do I hear $1 million? Impossible.
Now let's get you sorted.
Talk to an ANZ home loan coach to help make your new home possible.
It's very emotive. If you look at it, it's a young couple struggling to get themselves onto the housing ladder, attending auctions in dreary Auckland weather, and failing until they meet their ANZ home loan coach. If you compare that to an ANZ advert, I've sent you another one from 3 or 4 years ago.
Make it yours. When you find the home you want, talk to an ANZ expert about Buy Ready.
It was very much the 50, 60-year-old generation. Go make it yours, and you'll win because of an ANZ support. BNZ as well. They're switching their focus away from this investment side, and investor loans as a proportion of overall lending have been reducing over the last 12 months. But what's happening is that the first-time buyers have been suckered into thinking that, oh, it's a great time for me to get in. And I think a lot of that is because so much of the mainstream media is just pushing this narrative of buy now because they're always going to go up. It's a big debt for equity trap that we saw in Ireland and we saw in the UK. There many people who were buying their first home 25 to 35, then hamstrung when the prices went backwards.
So, Joe, it seems to me that from what you're saying, there's a bit of sort of a hype going on at the moment. In other words, get in now. Prices are there, but actually now's a great time, particularly for a first-time buyer. What's your perspective on that?
I think it's a very, very dangerous time for people to be seduced by the media, and New Zealand has, as a country, it's something that I'm not worried about, but it is a little concerned that there is so much control of what articles appear in the newspapers. The first-time buyers desperately to try to get into a house in Dunedin, the first-time buyers and their stories about how they're having to compete with everybody in the Hawke's Bay and all the investors that are moving there. The first-time buyers unable to get into a Wellington home because the investors have taken them all, and if they don't stop eating avocado on toast, they'll never be able to buy a property. And it is pushed. The major profitable business in New Zealand are the banks and the real estate sector. Yes, we've got agriculture and we've got dairy, but the power of the banks is enormous, and they're lending $4 or $5 billion a month into this market, and because we've had volumes of transactions declining over the last couple of years. There was a little spike this October because everybody rushed to beat the foreign buyer ban, but year on year, the peak was 2016 in terms of the volumes of sales. They've been declining since, and what concerns me is that the banks have largely still been able to increase the amount of household debt in the system on fewer transactions. That means that there's fewer people taking even bigger mortgages. The average mortgage in New Zealand now is $400,000. In Australia, I think you've got a $400,000 average for mortgages. Those different dollars, but a similar scenario. And my concern is that actually the weight of this lending is all being focused again on a marketplace who maybe didn't experience the GFC because they were still at school, or they're in their first job, or they're on their overseas experience, and they've come back in their 30s, probably largely oblivious to actually how housing markets can create a mess. And I just think it's really, really negligent of the Advertising Standards Authority to put on some of these adverts between the news, because it just creates this absolute panic and hype for first-time buyers to be really, really scared about never getting into the marketplace. So from my perspective, I just want people to think, okay, you've seen that advert and the ones that we've just highlighted. Think about what really are they promoting. A million, the ANZ advert, $1 million to go and buy a shed in the rain in Auckland. It's ludicrous, absolutely ludicrous. And it wouldn't have happened 5, 6, 7, 8 years ago.
And in fact, in Australia, we've had for the last 2 or 3 years, the fear of missing out has been the fundamental driver, particularly for the first-time buyer sector, but other sectors too. It's beginning to turn now, and now it's the fear of not getting out. So as the market swings and turns, you can actually start to see that change of sentiment. But nevertheless, the fact of the matter is there are still people hyping the fact that, must buy, it's really important. And of course, you've got to say to people, do your own work. Ask yourself, what are they really saying, and why are they saying it? That's the critical question to ask.
Yeah, I think a lot of first-time buyers don't understand that a 30-year mortgage term is a long period of time. And actually, that first 5 years that you take on that mortgage, you're probably only going to pay back 10% of the capital. After 10 years, you might have paid back 20% of the capital. If we are at a period, you've got to think, prices have gone so far, it's not unlikely that they're going to correct. They could correct quite a bit. If you are saving yourself, even if it's 10%, and there are suburbs in Auckland now which have fallen 5, 6, 7, 8% over the last 12 months. If you are saving yourself that 10%, you've actually saved yourselves, and if it happens in a year, you've saved yourself 4 years of mortgage debt. That's, in my world, getting onto the golf course 4 years earlier. So people need to think about, okay, if these things aren't always going up, but there is a risk that I'm carrying that debt when they're going down. Sydney, there'd be a lot of people who bought in 2017 with low deposits, 10% deposits. Their equity's already wiped out, and nobody's shedding a light on this in New Zealand. Nobody's issuing that warning. All the while, the banks are trying to change the focus from the RBNZ on allowing them to relax their lending criteria and offer more high deposit lending. It's ludicrous.
Yeah, and it's a sign of late cycle behaviour. So we see it again and again. We see it here in Australia. We've seen it in the UK and other places too. As that credit momentum begins to ease, in fact, the rate of hype increases to try and actually kick the can further down the road. So effectively, this is another leading indicator of potential trouble ahead.
And you've got also a lot of, commentary from the banks at the moment in the mainstream media, trying to push for the Reserve Bank of New Zealand to relax the lending standards again, and allow them to loan greater proportions of their mortgage debt book to low deposit purchasers. It's a very, very scary situation. You and I know that banks survive by creating money out of nothing, and that loan gets written as an asset on their balance sheet or as a deposit, which they then take their interest off over 30 years. And if you look at the market over the last 2 or 3 years, the volumes of transactions annually have been falling quite significantly. Just in Auckland, for example, Barfoot and Thompson, who are the largest agent, have the largest share of the market and have actually been increasing their share of the market over the last year or so. They were typically selling 11,000 houses a year in Auckland before the bust. Now, those numbers are likely to be in and around the 8,500, 9,000 houses a year as we go through. And what it means is that there's a lot of first-time buyers in the absence of as many investors who are being duped into buying these houses. Investors are taking their capital gains. The first-time buyers are now replacing that equity with debt. So it's from my angle, and it's something that, because I've seen the fallout of this in other markets and in markets that I operated in, I just want to be somebody as a voice who's offering a bit of a warning.
And do we have data on the share of first-time buyer loans versus the rest of the loans being written at the moment? Is that?
Yeah, we do, and the data is increasing. The majority of the mortgage loans being written are for existing borrowers. The investor market, they break it down: investor market, existing borrowers, and first-time buyers. The first-time buyers as a proportion has been rising into the 20%, having been lower. The investor proportion, which was up in the high 20s, is now falling into the lower 20s. What's really unclear in New Zealand, and I don't understand why they can't report on it, is that the RBNZ, they show the growth in mortgage lending every month, and you can go and find their stats. What they talk about in their stats is that proportion of loans that are to first-time buyers, proportion of loans to investors, proportion of loans that are interest only, and there's various commentary, and it's not clear how much is interest only. It looks, when you look at the data, that over the last few years, interest-only loan book has been close to 30%. But the challenge with the data is it's not quite clear because they lump revolving credit mortgages into the interest-only segment, when in reality, revolving credit, as I understand it, should mean that it would be in the repayment schedule of a mortgage. So the data again, and the RBNZ, it's so easy for them to go to the banks and ask for this, but they don't, and they haven't been reporting on it.
Well, of course, we have somewhat similar issues with our data here. For example, the first-time buyer statistical data in Australia shows the number and relative proportion, but it doesn't include first-time buyer property investors. So that whole segment just is not shown at all. And that was actually quite significant. It's sort of less significant now. And the other interesting thing from my survey data is that a lot of first-time buyers sort of assume that if prices have dropped a little bit, then it must be a good time to buy. But of course, even if you go in with an 80 or 90% mortgage, that 10 or 20% equity that you hold is effectively at risk if prices continue to slide. And now suddenly here in Australia, first-time buyers are saying, hang on a moment, prices look as though they're going to continue to slide, so maybe I should hang off rather than actually get sucked in. So, we saw a spike earlier in the year, and in fact a lot of the states started offering increased incentives to try and get first-time buyers into the market to replace the property investors who are actually walking away. Sounds to me as though there's a bit of a similar dynamic in New Zealand with now all the focus on the first-time buyers. But just, to state the absolutely obvious, home prices do not always have to continue to rise.
Yeah, well, I think this we've had it over here, and I'm sure you've had the same in Australia. Is the whole pressure on the media on young people not to eat smashed avocado on toast anymore, and it's because of smashed avocado on toast that people can't afford a house. Apparently, what I'm seeing from the media is this hype of the regions. I think you're getting a little bit in Australia now. Oh, Hobart's gone up by 16%, tiny little market, which is focus of the Australian property market.
I know.
Complete neglect of what's happening in Melbourne and Sydney. And we're getting that here. Auckland has now been largely swept under the carpet by the mainstream media. They don't want to talk about it. But what they're quite happy to talk about is how wonderful life is in Dunedin for all those prices that are apparently being inflated by money. And what I think is something that I would like to offer as a warning to first-time buyers is that there's been this narrative of, okay, you can't afford to live in the area that you work in, the area where your kids go to school. What you should do is go and buy a house in the region for a few years and flip that. And I've got some very interesting information which I want to share for another post, because I want to talk about the investment bubble, about how this has led to some areas being completely unstable for tenants, because landlords are only landlords for 2 years before they flip their house and they want to move on. There are pockets of New Zealand now where if you look at the availability of properties for sale today, 30-40% of those houses were only purchased in the last 2 or 3 years. So landlords are buying them. Tenants who may take a rental for thinking, I've got a stable house for a year or two because I've got a professional landlord. You don't have a professional landlord. Your landlord's going to be flipping the house in as soon as the tax benefit for not paying capital gains after 2 years has gone. That's what they've been doing. The trouble is now it looks more like a flop than a flip. And what it's doing is it's created some very, very artificial markets in the regions. I want to talk about just some data today, because data's quite important, and these are things that aren't publicised in the mainstream media. You have to go and find it yourself. And just to say, talk about inventory levels, because the marketplace is slowing. Inventory of properties for sale is rising nationally, and time or average time on market stats I don't think we can rely on, because they talk about average time on market of around 30-35 days in various parts of the country. And yet if you look at the realities, we've now got 38,000 houses, 38,208 houses on the market nationally. So that's houses and land and home packages. We only sold 6 and a bit thousand last year, so there's stock in the market months worth of property sales, and yet there's an average selling time of 31 days. That's not the case. There must be, and I'm going to talk about some numbers from Auckland. There must be an awful lot of property that is trying and failing to sell, and being withdrawn from the market. Maybe to have an attempt at a later date, but actually the prices aren't being realised, and the market is or the sellers have decided to give up. So just a quick one on the real estate stats. I was tracking the houses that are for sale in Auckland and nationally through from June all the way through to the end of August, early September. And I made a mistake, I'm afraid, because I was using TradeMe data to try and forecast where things were going. TradeMe listings were at a certain level. And then I went away for a few days and I came back and I thought, hang on a minute, TradeMe's broken. It was stuck at over 32,000 listings, and there was no ability to go and actually find out how many listings there really were. So back in August, I had to stop at 32,000 with TradeMe and switch over to realestate.co.nz, who thankfully haven't broken yet, and therefore I can see how many properties are coming on each day, and sometimes you're seeing fairly big dramatic days in property or rises in the availability of stock. So we're going to go to just look at the last 6 or 7 weeks. In Auckland, on the 5th of October, so this is before the foreign buyer ban as well, there were 12,681 properties for sale. On the 16th of November, I did try and look this morning, but there seem to be so many people on realestate.co.nz that I couldn't get in to access the website. So I'm relying on numbers from the weekend. Auckland, on the 16th of November, there were 14,231 listings. So from 12,681 to 14,231, quite a sharp percentage rise, 12.9% increase in availability in 6 weeks. Nationally, it stood at 33,448 properties on the 5th of October. And today, it has risen to 38,208 properties for sale. So that's quite a dramatic increase over a very short space of time. And it explains to me why this focus is now being so heavily pushed on the first home buyer narrative. The investors, most of them, hopefully, will have had an idea about mathematics and that yields in many places don't stack up. There is the risk that negative gearing allowances will be removed. There is a possibility that the bright line test for capital gains may be extended from 2 to 5 years. Those haven't happened yet, but even without them, the numbers don't stack up as a yield investment. It's quite interesting. I heard over the weekend, Martin, that the New Zealand Property Investors Federation CEO, who has been talking about a flat Auckland market, a flat housing market for most of the last year, and he's it seems a very sensible guy, talks a good story, he gets an awful lot of press coverage, has resigned and has decided that he will go away from his position on the 1st of February. Been very influential in the market, but we're not seeing that flat line. Are we seeing that flat line now? And if you're saying that, stick by it and stay in the business that you're doing. Something else I want to talk about is tracking listings and sales rates. Again, I'll return to Barfoot and Thompson, who are as a previous property professional, they're my favourite agency from a data perspective. They are incredibly transparent. I think it's really, really important with agencies that they allow the buyers and sellers to go and look at the data. You don't have to give everything away. You're an estate agent, you want to sell houses, but provide the data, and then people, if they're smart, they can work out what's going on behind the numbers. I've got some reality from Barfoot and Thompson about the listings and sales rates since February, or the end of February this year. I'll just read some of these out. In March of 2018, Barfoot and Thompson listed 1,689 properties. They sold 1,064. In April, they listed 1,358 properties, and they sold 731. In May, they listed 1,455 properties, selling 1,027. In June, 1,210 properties and 903 sales. Quite a good month in terms of that conversion from sales to listings. Low listings, but not bad sales as a proportion. July, 1,057 listings, 830 sales. August, 1,331 listings, 795 sales. September, 1,709 listings, 722 sales. And October, 2,046 listings, 884 sales. So the sales went up in October from September, but there's an awful lot of listings that came on as well.
And just to be clear, those are new listings, right? So those are the ones that came in the month, right?
They're the ones that came in. And they're very, very open, Buffett and Thompson, about what their overall register of available homes is at the end of the month. And that's why, again, if people want data, Buffett and Thompson, great place to go and look. So since March, there have been 11,855 new listings coming to the market with Buffett and Thompson, who are Auckland focused, and they have sold, of those listings, 6,956. At the end of February, their stock levels, which they said were, okay, so this is our starting stock going into March, they had 4,648 properties. And at the end of October, they had 4,848 properties. So there's not been a massive change in the overall ability. But if you look at how many come on and how many are sold, where have all the others gone? So for quick calculation, which hopefully you'll do for me on the screen, it shows that actually 6,956 sales divided by 11,655, which is the total available stock. So the new listings making a reference to the difference between what the entry point was on March the 1st and where we were at the end of November. Only 59.7% of the properties that they're listing are selling. We've talked about the auction rates previously dropping, and not all houses sell at auction. So we're actually seeing 41% or nearly 41% of the marketplace listing, spending money to advertise, not getting the result they want, and disappearing. They may be disappearing to go on with other agents, and I'm sure Buff and Thompson benefit from other agents failing to sell a property and then getting a new listing. But it's quite a telling stat when you actually think about the how strong this market really is relative to what the mainstream media and the bank-sponsored press are telling everybody.
Very interesting. Yeah. So we're seeing similar things here with effectively the numbers of listings rising, the volume actually selling going sideways or down in many places, but also a lot of this repeat listing. So it comes on for a few weeks, doesn't sell, disappears, then comes back on, perhaps with a different price, perhaps a lower price. And of course, then there's a new campaign or a different agency involved. So we're seeing the same property popping up over a period of multiple months from different agencies at different price points. Never saw that a year ago.
Yeah, and that's an indicative sign of a turn in the market. And I've established a consultancy now, and I'm here to talk to agents. As an ex-agent, I feel for them because I've seen this. You think about the 1,700 agents at Buff and Thompson alone, and if they've only sold 864 properties last month, there's 50% of their agents haven't sold the property. So it's quite a telling change in the marketplace, and they're going to need an education as to how to deal with this changing dynamic.
And presumably there's a commission-based fee structure in New Zealand as in Australia. So in other words, it's a proportion of the total value that actually generates a fee for the real estate agent. Is that the way it works?
Yeah, absolutely. It's the same. It's generally a no sale, no fee scenario, but where there are some quite big advertising costs. Right. So unlike the UK, where in the UK, the high street estate agents don't charge a penny until somebody's moved. They don't charge to advertise. They don't charge for internet presence. They don't charge for doing open homes. They don't charge for taking a property to auction. What they do charge is when the house sale completes, that's when they expect to get paid. Over here, you've got, well, 40% of Auckland sellers at the moment are spending money upfront to list a house, not getting any information or not obviously getting the right information about their chances of success, and are spending that money for nothing, for no result. That can't carry on forever. And as a consumer, as a property consumer, it's important that you know, if you are a vendor, you need to know what your likelihood is of selling, because you're forking out all this money up front.
Yeah, it's very interesting. So Edwin Almeida, the guy we talked to about Sydney property, made the point on one of his previous posts was that a lot of the real estate guys are relying on those upfront fees to help effectively pad out their financial performance, because effectively the overall commission pools are going down considerably. And in fact, his view is a bit like yours, was, well, you know, if you don't actually understand the likelihood of the probability of a sale, then potentially you're just throwing money at the real estate sector for no real good reason.
Yeah, and that's wrong. I mean, I would welcome a no sale, no fee arrangement in New Zealand. I think for the consumer, it's possible. It doesn't cost a lot to put a property advert online, and generally, over here, because there's such an emphasis on open homes, the agent's only there at the property for 1 hour a week. You rarely get a phone call from them afterwards. So there's a lot of training to be done within the industry to improve the consumer's experience and the house seller's experience.
And in fact, Edwin's of the view that those that actually perhaps even offer a fixed fee for a sale rather than a variable fee based on the size of the property or the size of the transaction are beginning to actually appear. And so his argument is that the whole economic basis of the real estate sector is up for grabs at the moment.
Yeah, I think there'll be some big structural changes within the market and how the industry operates. Volumes are likely to be low, as we talked about, and there will have to be some major structural changes, some major improvements in quality, and those things. It's inevitable as the market tightens.
And presumably a shakeout in the number of real estate agents and offices.
It's what's happened in the UK, and I can't say that I see anything different happening here. The number of people that were operating in the industry, initially it happened with a decline in the number of people per office. I was lucky in our business. We were incredibly focused on making sure that we hit number one position and maintained it. But yeah, the thinning out of staff, the decrease in the quality of service, the decrease in the follow-up, and it's a relationship business at the estate agency, and it's very important that people have relationships that they can the client needs to trust the relationship, but the relationship also needs to be good enough that you can tell some hard truths to, and get the right advice to your client.
So in summary then, it looks as though the intense focus will be on the first-time buyer sectors, but first-time buyers should be very aware of where the market currently is, and those in the real estate sector perhaps should begin to think about the what-if scenario if things begin to ease. Absolutely. Joe, thank you very much. I appreciate your perspective, and I'm sure we'll talk again soon on the New Zealand sector.
Thank you, Martin.
Great to talk to you. Thanks. So there you have it. An important warning from Joe there for first-time buyers in New Zealand and perhaps elsewhere too. Beware of this hype during this part of the market cycle. If you like what you've seen here today, please like the post, share it, add a comment or question. We do read them all. And check back next time for our latest post. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you next time.